You want to tell a story. You want to get to value as soon as possible. I have this amazing, I'm the first and only, no one's ever done this. We have no competitor. Great. All throwaway words. Your customers don't care about that. The press has heard this all before. How do you do it better? Or why do you suck less than your competition? We try and just cut it down. Because what, Benjamin Franklin, if I had more time, I would have written less.
All right. Welcome, Harry. Oh, wait. Harry's not here today. It's just me, Colin. But I have a great guest, Trace Cohen. Welcome to the show.
Hey there. Glad we could set this up.
Yeah, no, it's been a long time coming. Mostly my scheduling woes getting it up, but I'm excited to dig in. I'm going to try and do a good job of reading your bio, but you can feel free to color in any of the things that I miss. But you're a serial entrepreneur, 15 years of experience. Your first startup was Brandyourself out of college in your dorm room, which is super fun. And then you did a few more after graduation, and you've been angel investing, it sounds like, for quite a bit of time, 60 plus companies that you've invested in. You also went to Columbia Business School, so it sounds like you're a New Yorker at heart and currently live there. And then you also are investing today through New York Venture Partners, and I'm gonna have to ask you a little bit more about that. But anything else you want to add? I think I got it.
Yeah, so the whole thing about starting a company in college, where my parents are entrepreneurs, not were past. They built and sold a company, and they highly encouraged my siblings and I, my older sister, younger brother, I'm the middle child, to start our own companies by 26. So as you mentioned, I'm a New Yorker born and bred. I went to Syracuse, studied and majored in entrepreneurship, started my first company on my dorm room with my best friend and roommate, and then went to Columbia, and I'm back in New York on Long Island now. So that's why we're New York Venture Partners.
Got it. And maybe just touching on that a little bit before we go into some more of your background and specifics, does that mean you focus only in New York in investing, or are you abroad? What do you guys do?
So before the digital era, so I started my first company in 2008, right? Like when Facebook started. So there wasn't all these Zoom or WebExes, and our network was in person. That's how we got business done. And so at least in 2008, I was running my company, and then a few after when I graduated in 2010. But really, jumping ahead, is my father's been an angel investor probably for a few decades, but more focused and full time since about 2008, 2009, when he took over and ran the New York Angels. So as that name implies as well, we're New York Venture Partners, which we started in 2015, 2016, but he took over the New York Angels in 2008-9. And that was mostly New York deal flow. And when I would give my young millennial advice to him, it was all just based on my New York experience. And when I joined him kind of full time in 2014, 2015, it was just everybody we knew in New York. So we wanted to invest in like New York companies, because that's where our deal flow, our expertise and network was.
Got it. So just more of a convenience and, what was from your network and things like that.
Yeah. I don't go to San Francisco much. At the time, I wasn't really going to LA much. It wasn't too much of a scene. I think Snapchat was on the up. But New York, it was definitely interesting. We didn't have like the Datadogs and all these DigitalOceans and other companies that are like the $10 billion plus market caps now. A lot of consumer and a lot of fintech, a lot of fashion, CPG. Now we're getting more into the enterprise, B2B, kind of large AI companies.
Yeah, that makes sense. And ironically, the companies I have invested in New York, or in state and New York, are both fintech and fashion. Which, not surprising, Yeah, no, it's interesting that startups tend to mirror a bit of like the industries that are surrounding them. I don't know what that says for San Francisco though, because they're all over the board. But the point being is, it's an interesting. It's an interesting path dependency I hadn't really ever thought about.
And they have the universities, and that's really what it comes down to, is they have the Stanfords of the world. New York doesn't really have in the city, from Columbia and like NYU, they're not great technical schools. And so then Cornell Tech came a few years ago. It was kind of helpful, but you don't get the same people as you would at kind of like MIT or at Stanford or some other schools. And so we never were the heaviest in tech talent. We were always very heavy in business and finance.
Interesting. Huh. Well, it's fun to talk about. Now in my head is thinking about this whole world of, wherever you start your company seems to have some kind of reflection of all the things that came before it and your shared history there.
Yep.
So I want to get to know you a little bit better in your journey in angel investing. And we'll start with a few rapid fire questions just to kind of get to know you. I've already asked how many angel investments have you made. It sounds like 60 plus. Is that
Yep.
sound about right? And I guess, how many angel investments do you plan to do this year, or have you made? What does that look like?
So we have 60 investments really over the last decade, probably 4 to 5 when my father was doing it full time. When I joined him, he got it more kind of 4 to 6 and increased it all the way up until 8 and 10. And then with 2021, the crazy year, we did 12 investments. So like basically one a month, or there was one month where we did three, just it happened to work out that way because VC is kind of chunky, right? You have the beginning of the year, don't bother me in the summer, don't bother me during Labor Day. You have this little window between like Labor Day and Thanksgiving, and then maybe one squeaks in before the end of the year. Three follow on. Everybody else, the last few years, we've definitely cut it down. So we've done about 2 to 4 just last year, and so far we're planning to do this year as well.
Got it. And what is your typical check size that you guys do?
Yeah, generally 25, 50,000 up to 100,000 in follow on, and we really try and be as early as possible. Less than 10 million valuations is kind of our sweet spot. Our goal is to make money. So if you get in early and get a lower valuation at multiples, it definitely hopefully returns a lot more.
Got it. And is there like a certain, I know you said you want to be early, but is there certain kind of pattern recognition, stage type that you're looking for?
You can call it whatever you want, pre-seed, angel investing. As long as it's below 10 million, it's really kind of just nomenclature. And below a 10 million valuation, if we're going to be like the first check or part of that first capital raise, we generally don't get the repeat founders who are going to just command a 10, 20, even 30 million, and some higher in those crazy days of 2021. And so it's really just a bet on the team and their experience. Hopefully, we have the expertise, some of a network, and understands what we're investing in. So yes, we made some AI, machine vision investments. I'm not technical, don't have a PhD, but fundamentally I get what they're going after. I know the market, I know the customers, and we have a background in PR marketing. So that's where we really try and help a lot of these companies, especially early on. It's a underappreciated skill set that can be very powerful.
No, that makes sense. For the 5+ startups I've done, PR has always been one of those differentiating factors for the ones that I've seen that have really gotten great exit velocity. It's like, it's a muscle to build, like anything.
Yep.
Right. And if you get it right and you do it well, it's like super powerful. And I think it gets confused with brand a bit. They are interlinked, right? Because, the more your name's mentioned, the more, repetition and therefore brand recall there is. But they're fundamentally different things, right? But maybe tell us a little bit about like, how do you help companies with that and coach them on that front?
So first is just understanding, as you said, what their brand is, how they're perceived, and how they own it. So great. Everyone thinks of PR as a press release. I send it, I pitch a journalist, and I get PR coverage. But when we work with companies, we want them to also have PR, a strategy with their customers, how they reach out, what brand, how they're perceived, because we like to say it's not what they read, it's what they understand and what they comprehend. So we work with them and media training, how to talk at conferences, how to talk to the press, how to talk on podcasts, understanding who the audience is, always benefits. So you want to tell a story, you want to get to value as soon as possible. I have this amazing, I'm the first and only, no one's ever done this. We have no competitors. Great, all throwaway words, throwaway sentences. Your customers don't care about that. The press has heard this all before. You're not unique. Everybody has done this. How do you do it better, or why do you suck less than your competition? And so we try and just cut it down. I think it was what, Benjamin Franklin. If I had more time, I would have written less, maybe Abe Lincoln, right? So really focusing on that and getting ahead of it. And so I'm helping a lot of my founders with media, because you don't have to tell someone, oh, I can't share that. That's kind of confidential information. That's a waste. Saying, play the professor. You are starting this company, doing something crazy that most people dream of, to put yourself through this. What do you know that others don't? Play the professor. You have some insight. What have you learned? What can you teach me? I want to walk away from a founder pitch, or even as a consumer, be like, oh, wow, I didn't know that. I should be taking this supplement. I should be using this tool. That makes sense, and it just clicks.
Got it. Yeah, I mean, it's funny is that using and pitching is probably very similar to PR. When people think.
Oh yeah. I had a call with one of my founders before this, and actually just one just texted me. I just got off a call with a journalist. Sorry, like I was on a call before with another founder. Wanted to run it by me first because I want to be your first call when you have to talk to a journalist or planning to, just to prep it. Trust me, when someone turns the camera on or someone puts a mic in your face, you go blank. And unless you're ready and you know your bullet points, you know what you're going to say, it really is training. It is a lot of fun because I get to be really annoying and ask you questions.
Yeah, well, it sounds like that's what you love doing, and you've figured out a really great way to marry, adding value monetarily, but also through the actual like process and operation of doing PR, which drives huge enterprise value for the business. I mean, it's
Yeah.
probably one of the few marketing channels that are, just growth channels in general that has pretty unlimited upside if you get it right. Like, just like the potential virality of it. And it's really also just a lot of marketing channels, which are also multiplicative or exponential on all your other channels, right? Like,
Yeah,
so no,
it
it's
is
a
hard.
good area.
I don't envy PR professionals having done it for years, working specifically with startups in 2010, 11, 12, when like a pre-seed or seed round was like $1 million and you had high expectations. That's exactly what it comes down to.
So one question on that, I think looking back at all the startups been with, it was always the PR always came around and you got your first dose of it when you raised your first real round, right? And it was like, let's go get TechCrunch to write about this, or whatever it was, right? And that's like, and then that was like, that's PR, right? I mean, how do you coach founders on this whole press release around funding? I'm intrigued to hear a good take on this.
So when I had my agency, it was we won't sign a startup for less than 6 months. Otherwise, you'd be a hired gun. You raise money, you're trying to use our kind of journalist connections. Right now, at least when I did it, was 4-to-1, probably 5-to-1 PR professionals to journalism or journalist writers. And so it's getting harder and harder. Most people just kind of copy and paste spam. You build relationships. Some people have them. And so a lot of the time, we write the press release and it's fun. It's just kind of a mind stream of what are the headlines that people want to read, the subheader, the first sentence of like, what is the announcement, the partnership, and then you can get into quotes, bullets, links, and probably 50% of the time, the articles are just directly taking what you wrote, which is great because then I control the message. We didn't want to get hired for less than 6 months. And so when I work with my founders specifically, and the worst is when I was pitched early on my agency, they're like, hey, we're the best. We raised $1 million. It's amazing. People love us. Unfortunately, it's like pitching a VC or any investor. It's like a 1 in 100 shot. They're busy. So you try and fluff it up as much as possible. Like we're raising this amount of money from these investors. We're making this partnership announcement. But once again, what are the benefits? Who cares? If you're a journalist, you need headlines and good stories. It's not all about the views. It's a lot about the views. So who is going to share it out? And so what we do is we write a lot of different press releases over time because it's also content and SEO, because assuming you'll be successful, people are going to Google search you and they're going to try and look for articles written about you, credibility. And so we want to write a lot about partnerships, about hires, not just funding announcements. Those are the glitz and the glam, but the funding announcement, at least from an investor founder standpoint, that's just the beginning. Like it is hard to raise capital, but then what do you do with this capital and the expectations afterwards? So we like to think of it as like a launch period. You don't just launch the company, you're launching the idea of it. You then make iterations and hopefully you can then talk about the outcomes of what came from that. Were you right? Were you wrong? What did you learn in this process? So just constantly on the move.
Yeah, I've heard it called rolling thunder is like a great strategy.
Yeah, I like that. It's definitely like as well. We had some really tough thunder here. So yeah.
You don't have to be kind to my euphemisms. It's okay.
No, I like it. I like to take it from people. So I might actually use that.
Perfect. Get back to like the angel investing side a little bit more. A super fun conversation. I think tactically, and a lot of people who listen are actually founders and operators. Take me back. What was your first angel check? And maybe a little bit about more about the process, how you found it, like check size, what you learned, things like that.
Yeah. The first one that comes to mind, I think it might be Laughly. And so this came through the New York Angels. This was our deal flow, and I was just kind of getting started. And this is when apps for everything was kind of coming out, Spotify for music. And this was, I'm a huge fan of like South Park, and I used to love all the comedy bits of all the major comedians. And so this was Laughly. It was like Pandora for comedy, which made sense. Everybody was coming out with bits. This is when started getting their own shows, and I liked it. And it's one of those things where you fall in love as like a user, which sometimes is good and bad because it kind of blinds you and just naively didn't know how big the actual market was. And so they had users, it was growing, they were getting the content, all the IP rights, but it was a small market. And that wasn't something that I was aware of. And I think they came through the New York Angels after they just finished Jason Calacanis's launch incubator. And so nothing to discredit Jason, but I think I put too much weight on the fact that like, oh my God, he's investing. But like, I didn't understand fully the concept of like an incubator, that there were also dozens of other companies coming out of it. It's kind of like a cohort, and it just didn't work. Like a lot of other consumer companies, they had revenue, they had some growth, but it never kind of took off. And so definitely learned a lot from that. Subscription consumers have no idea what they want. Generally, they have to be told. We are fickle, especially now. So that was 2015, 2023. Like we have the memory of like a goldfish. Ooh, that's new and shiny. Tomorrow, something new and shiny. So definitely trying to stay a little bit away from consumer these days. But still, one of my better investments is a consumer product that I never would have thought anyways.
Well, maybe tell us a little bit about that.
A smart dog collar called Fi. So I'm a dog guy, love dogs. My dog ran away when I was younger. We him obviously, and it worked out. We have a dog, so it's one of those things. Once again, you kind of fall in love with it. Like, oh, I had this problem, and so this solved the problem. It's a Geo collar that's kind of like a Fitbit for dogs. And hardware is hard. That's what everybody always says, but they're doing phenomenal. The founder's amazing, figured out unit economics, and it's a problem that if you are a dog owner, you understand. And luckily, there's a lot of dog owners. But no, never did I think like, oh, investing, yay, cool tech companies would dog collar be one of my better investments, right? You're like, oh, I need the Facebooks and the Googles of the world. So luckily, it's is hard, and it's a good moat.
Yeah. I'm very little in hardware personally, just because mostly I don't have any expertise. Like I don't have like a comparative advantage in investing those things personally, or an edge, I guess you want to call it, right? I don't in life, but I think what's the things we always hear from people about their first investments is they put too much money in, or decided too fast. Did you feel like you made any of those common mistakes up front that kind of changed how you do everything going forward?
We definitely didn't do it too fast. If anything that's happening these days, and I think we're going to get back to it, with the pendulum swinging back to investors, was we did a lot of diligence. Numbers didn't tell us otherwise. Like, so for like Laughly, it was consumers on the right growth path. We just didn't see how it could go really beyond like, I don't know, like a Series A, but they did raise follow-on capital. So that's where I was naive in terms of like growth capital. So like, cool. When I make an investment, at least now that I've learned, is probably people think differently today, but at least for the last few years, is I'm investing in a pre-seed seed up, and generally they won't be profitable. They won't control their own destiny, which is all the advice we're giving founders today. But I need to invest in a company that can raise more capital. That's the game we're in. So I might like the founders, I might like the idea, the product, the company, but no matter what traction you get, or if you're not raising enough money to get you to that next round of like a Series A, I'm a scout for Series A. In 2021, the last few years, I was just on the phone and meeting with Series A companies to find out what they want to invest in, trying to predict the future of like, great, if I invest in them now, what are they going to invest in a year? And so that was a kind of clicking moment for me. I know I'm supposed to just invest in the greatest companies and they'll figure it out. And some have. I can't help them all, but like that's what I'm trying to figure out. Like, is this a fad? Is this a lasting kind of trend? Will this live on, not just for a few years, but like, is this going to be something in the future? So that was a realization I had years ago. Really what we say, and it's just that like the value add statement is we invest in founders. Generally, half our investments are pre-product, pre-revenue. And so we have to believe the founder has the expertise, they have the network, they have the knowledge, they can sell, they can hire, they can go out and raise capital, they can motivate through the good and the bad. Whether they're a solo founder, which is sometimes good at being a benevolent dictator, or they have a well-rounded kind of co-founder team of a CEO business, a CTO if it's technical, maybe a CMO, depending on what they need. So that's really what we focus on early on.
Got it. Yeah, the whole insight around exit liquidity is really important. And while like, future funds being written, we raise the seed and then A and B, they're not necessarily exit liquidity, but in some sense, you always, to have an exit, you have to have someone that's willing to pay a higher price for the thing that you bought in at, right? And so
it's not
interesting way to think about
theory.
it. Yeah.
If someone invests, when people ask, like, what do I invest in? Things that will make money, make like revenue and profit and net profit that will exit. I believe when I give you a check that I will get back 10 to 20 times my money minimum. And so when people say, oh, founders, don't worry about the exit when you start. No, you should worry about the exit. You are building a company to sell it, whether it's an IPO to sell into the public markets or sell to another company. But that is the goal, to look like a tasty piece of cheese and get acquired by somebody else.
Yeah.
That's the goal, to exit.
Yeah, no, I think because there's like a lot of people that believe in like mission-driven founders, or like what are they in it for? To solve the problem. They can both be true at the same time. You can be mission-driven and have an exit philosophy, right?
Right. As you can be mission driven and you just happen to have an exit. No, I want to make it clear that if you take venture capital and you'll see it on Twitter, like, oh, they forced us to grow. Well, that's their business model. You need to understand their business model as they understand yours. And so, okay, great. Forced growth and everything that happened. I think we're kind of getting over those crazy days now, and we're starting to become a little bit more rational. But still, you need to grow. You need to continue hitting your revenue, your growth targets, whether it's just enterprise and logos, something that somebody else needs and wants.
Totally. One of the things, so it sounds like partners is a family affair on your end. About that dynamic, or sorry, not partnering, but investing with your family. Is it like investment committee? How does it work?
So initially, it was my father, and then I joined him, and he's my best friend. He came to my bachelor party, and we hang out. But like growing up, we all had to start companies, so it's not like we had like those very like formal dinners or anything fancy of like, oh, how was business today? It was just like we would talk tech. I went to CES with him 12 times. So like we'd geek out over products, and it was just a fun thing, like to talk something intellectual. And so when we find companies, we debate it, and it's a fun, healthy debate. Maybe it's like just how we were brought up to question things, like, why do you believe that? And so I actually had to hone my skills. Sometimes I'm a little bit aggressive, a little black and white with my statements in terms of how I make generalities. And I get caught on Twitter or other things like, oh, that's going to zero, that's bad, that shouldn't have happened. So I try and analyze that. And that's where the debate comes in, where we each have our own beliefs based on experience, and we discuss it. One, does this round make sense? Great, we can consider it. It's less than 10 million. This is the right amount that they have to raise. Two, do we like this industry? Is this something where it can be helpful? Do we think this is going to be a long-lasting industry, not just kind of like a trend? Oh, let's do some shoes. Let's do some consumer boxes. That was kind of cool for a while. That kind of disappeared. Direct to consumer, CPG. We all have them. Some are doing well, some not. But like some trends are AR. We debate that. Are we FOMOing? Like, are we angsting for this? But also understand we're smaller checks, like 25, 50, 100,000. So we value the time of the founders, where we'll take 1-3 meetings max. And so when people talk about diligence, we get at most really like 3 hours with the founder. So for $2,500, $100,000, we're very cognizant of their time. But on the back end, I research, I come specifically with questions. Now, having been doing this for many years, I've seen almost every iteration of every company. And so it's like, great, you're not the first and only. How are you better? Do you say you have competition? Dive in. our friends are invested in them. I have no insider knowledge, but like they have more money, they're farther ahead. How are you going to take their clients or beat them for future clients? And so that's kind of our diligence. And then we're like, great, do we believe in the team and the founders that a lot of our investments will pivot, not like a 180, but they'll figure something out along the way and they'll focus on new customer, a new product, a new market. And so between all that, we're like, all right, yeah, that's good enough. We're in, we're humble, we're going to be along for the journey.
Got it. No, it's kind of nice to have a team sport on it. And my mother also does some investing, just generalized investing in real estate and other stuff. So I always enjoy bouncing it off of him. And it sounds nice to have a more formal structure behind it to do it like on a repeat.
Yeah, an informal, formal structure. Like we'll sit down, we have the list of companies we've looked at, we kind of look at industry trends and news, and we kind of just like connect the dots these days because we've seen so much. But then again, they are wrong more often than we're right, but it is a hit business. And so now we're starting to see that happen with portfolios, ours, friends, VCs, that the numbers are starting to become more true. That some of these companies should have gone out of business a long time ago, but they were kind of artificially inflated. And so now the numbers are starting to become a little bit more realistic.
It is irrational winds is dissipating quickly, but also. All right, so I appreciate you answering all those questions. It was fascinating. And as always, I check every episode. Like the barometer check is, did I learn something? And there's a few things I've written down and decided to think about more. So on a more spicy note, we do our Twitter takes. So we're on Twitter all the time with some sort of dancing or whatever, with good startup euphemisms on top of it. So look at a few tweet X's these days. I don't even know what to call it, honestly.
Zeets.
I'm just like, I'm confused.
No, I like it. Bad PR, but yeah, I know. It works for now.
All right, well, I'm going to share my screen here. Our first one is from Gail, who was a guest previously on the episode or on the podcast. And I like this open-ended, but it was something that got me thinking. So Gail, what does the future of angel investing look like? I was just asked to speak about this on a panel and would love to crowdsource some thoughts. I'll write up my forecasting of future angel insights. Similar prize here. But read their replies. I'm interested to hear your take. What's the hope for angel investing?
It's not going to go away. Definitely it's decreasing now, but people always angel invest. And there's a whole range of, you're an angel investor, you made like one investment, you're somewhat of a tourist, but we need you. Like you're capital and it's cool for you. You get to talk about it, it's fun. And then there's the other side of a professional angel investor that we've graduated into. And it was something that you mentioned before that I want to bring up again, is you went quickly. It was really cool. There's a little bit of FOMO and you kind of invest in the first deal you saw. So I always want to tell angel investors who are new, and we did this at the New York Angels, and I tell this to my friends, don't invest for like the first 3 to 6 months, no matter how cool, even if Andreessen, Sequoia, anybody leading it, learn as much as you can first. Don't FOMO, don't hype into your first deal. The best thing about founders and entrepreneurship and startups is there's always going to be another one. And so, okay, maybe you missed a great deal. If anyone guarantees you a success or that this will make you money, first thing you do is you walk away.
Please walk away from that. Yeah, no, yes. I mean,
nothing is guaranteed in this world. Nothing is de-risked because you raise some money. If it's too good to be true, it is.
Yeah, having built and you built some yourself, it's like you kind of have this internal understanding of how much has to go right. And it's like this tally of things that has to go right that if you just said it out loud is like very unlikely. Like it's just inherently the probability is very low that all these things happen at the same time, or in serial or sequence, whatever it is, right? And I always think about that as I'm about to write a check. I'm like, I mean, I'm betting on some randomness happening, right? And some serendipity and some luck. And is this person able to harness the luck?
Are you a Marvel geek? Like you watch all the Avengers and all those?
I'm a fan, but not I don't live, eat, and breathe it.
Either way, at Endgame, when they're on the planet, they just lost to Thanos, right? Like Doctor Strange is sitting there, he's going through all the different scenarios. Iron Man's like, what'd you do? Is like, I looked at all the different scenarios of how many we win, of like 14 million, I think 103 specifically. and they went in one. Like the odds of this being a success, getting to like $1 billion in IPO, it's almost impossible. So I just want people to understand that if you make an investment, you should expect to lose that money, like statistically, and just only invest what you can lose. So I just want to warn people against it in terms of your ability to invest. But the future investing, it will become more rational. So the last few years, besides 2021, we were leading up through a large bull market with a lot of IPOs and acquisitions. So there were a lot of new millionaires, accredited investors created. And so what do I do as newfound wealth? I want to reinvest into the system, which is great because we are the scouts, angel investors. I love them because we seed literally and take the biggest risk of any investors. Like, yes, you can invest 10 million, 100 million, you're investing and risking more money, but they wouldn't be there without us. So I want to give credit to all the angel investors. Even if you have $1,000 or $5,000, you don't need to invest more. Just learn and don't annoy. And I have found on cap tables, more often than not, the smaller checks mean more and they add more value.
Yeah, that's 100% been my experience too. I mean, obviously, big checks are money and they're meaningful for salaries, all that. But to your point, like those are the people that go to bat for you. They do all the small things. Brian Nichols, who was one of our early guests, and yeah, he preaches this all the time. And I think when I first heard it, I was like, a little knock on my own self. Like I don't write big enough checks to be meaningful. And I think the more I talked with him about it and thought about my own experience and what founders told me, it was like, no, you're like one of the most helpful people. You actually take my call, you pick up at 9 p.m. at night.
It's not useful from maybe a monetary standpoint, but what comes with it is your network, your introductions, your expertise. That is useful. So that's the difference of smart money and dumb money. And sometimes we're even dumb money. I can't help you all the time.
Yeah. Well, sometimes you're just the commodity. You are the money. And that's okay. So
it is.
All right. One more tweet or Zeet, and this one's actually for me, so a little self-promotional, but I tweeted it today, and I think it's a fun one because I got in a few of these DMs, and I was like, man, this just rubs me the wrong way. So from Colin Gardner, the fastest way to get a no from an investor with a cold DM is to dump the Calendly link in their lap at the end of the message. Just me, or do others feel the same?
Refresh, see likes. I liked it right before this. I saw that, and I was thinking about that, so I should be one of your likes. But I have
there he is.
Yep, see, there it is. I do my research as well. And so, yeah, my DMs, I get probably a dozen a day and a dozen emails also that are just, copy and paste. I appreciate the cold DM. And if you don't copy and paste the DM, I'll reply back to you. And so there's certain things I don't invest in. No fintech, biohealth, education, insurance, and a bunch of other industries we just don't like or really believe in. And so I was just, great. Sorry, we don't do fintech, we don't do crypto, we don't do education. So a fast and easy no, it cuts it off. It's not just sitting there. But yes, if you aren't following me, we haven't engaged. Generally, I'll see someone reply to a bunch of my tweets, and then I expect to have a DM. Great, you put in the work. Just don't copy and paste all of it. Make it a little bit personal, but that's fine. But if you're going to copy and paste it, keep it to like a few sentences, a few bullets. If I see multiple paragraphs, and it goes the same for emails, I'm not reading multiple paragraphs, especially if most of it's fluffed. We're the first and only this, working on this, blah, blah, blah. No, just I'm a bullet points guy. My emails, I write a sentence, something, bullet, concise, next topic, move on. So that's what I like. I want to know your traction. I want to know your team. I want to know your raise. Send me a link to your deck. I'll click it. That's perfectly fine. But same thing with emails. I have on my website, if someone just spent 5 minutes like Googling my name, going to nyvp.com, I have a pitch us site. And it says, if you put invest op, OP, your company name, 9 out of 10 times I'll open your email and reply back.
Oh, that's interesting.
So it's kind of like a bozo filter that if you put in a little bit of the work just to go to my website and see what I ask of you in the header, it pops up. I have a filter in my email. I will almost guaranteed read it, and almost, unless it's really bad spam, copy and paste, like unformatted and like multiple paragraphs, reply back to you.
I love the bozo filter. That's a good line. I need to introduce some tripwires into my own flows. I think the thing for me about it is it just doesn't feel personal, and I think that goes with all things in sales. No matter even if the founder is the target at some point, it's like you're more likely to get engagement if it's personal. And one of the pieces of
Yeah.
advice I give to founders, a founder asked me the other day was like, what should I subscribe to or listen to, to be like most up to date on what's going on in startups, meet investors? And I was like, you should just get on Twitter and just respond to their tweets, and then just DM them, because all of a sudden they know who you are. And I was like, it's that simple. That was like the best investment that you could possibly make.
It's a great start. Little bit of work and a lot more upside. So the odds are still infinitesimally low for like a response or a meeting, but you put in the work and we appreciate it. And I totally understand. I don't need someone like doing your research on my entire life and doing like my background in bio, but this is a sales transaction business. People ask like what business we're in as angels and investors. And ironically, people think we're in the business of investing. We're not. We're in the business of exits. It's like bug versus feature. So the bug is we invest, the feature is exits. And so that's what I want to know. And that's why I have no problem with founders knowing what their exit will be and talking about exits and talking about making money. I want that to motivate them. You're not doing all this painfully to do some impact, you are, but I want to see that like in your pitch and come through when I talk to you as well.
Totally. All right. Well, this was super fun. I have a lot of little euphemisms I've learned that I'm going to be using, the bozo filter. But first off, Trace, thanks for coming on. I love learning about your experience angel investing. And I hope you enjoyed it as well.
Yeah, I do. It's fun and it's a pleasure to work with so many great and smart people every day.
Nice. All right. Thank you for being on.